On April 10th, Japan reclassified 105 crypto assets under the same law that governs stocks and bonds. And on that same day, Hong Kong handed out its first 2 stablecoin licenses, and just weeks later, Samsung and Hana Bank dropped over $1 billion buying into Korea's biggest exchange. Every headline reads the same way: Asia is opening the crypto floodgates, but here's what nobody's telling you. The banks are the only ones walking through, and they're cracking them open at the exact moment Asian retail is heading for the exit. So today we'll break down what Japan actually changed, expose who Hong Kong is really letting through, and reveal the settlement war hiding underneath all of it. I'm DC, and you're watching The Coin Bureau. When a government opens up to crypto, it can mean 2 completely different things. It can mean throwing the doors open to everyone, or it can mean building a regulated institutional on-ramp that only the biggest players can afford to walk through. Across Japan, Hong Kong, and Korea, it is consistently the second one. And the timing is what makes this truly fascinating. Bitcoin is sitting at around $71,000 right now, down roughly 8.8% on the month and a brutal 43% below its October 2025 high of $124,720. Crypto venture funding has declined sharply in recent quarters as capital rotates into AI. So the establishment is laying pipe during a downturn, which brings us directly to the biggest move on the board and the one that is getting the least attention: Japan. Put simply, Japan completely rebuilt its crypto rules from the ground up. On April 10th, the cabinet approved an amendment to the Financial Instruments and Exchange Act, the FIEA, the law that governs traditional securities. And for the first time ever, crypto is being treated as a financial instrument rather than a payment tool. So insider trading rules now apply. Token issuers face mandatory annual disclosures, and penalties just got savage, with maximum prison terms jumping from 3 to 10 years and fines climbing from 3 to 10 million yen. And then there's the tax. Right now, Japanese crypto gains are taxed as miscellaneous income at rates that can hit 55%. For context, that is more than double what a Japanese investor pays on profits from listed shares. The reform drops that to a flat 20.3% with a 3-year loss carry forward, putting crypto on exactly the same footing as stocks. So why does any of this actually matter? Because reclassifying crypto under the FIEA is the legal prerequisite for spot crypto ETFs. You cannot wrap an asset in a regulated ETF until it legally counts as a financial instrument, and Japan just made it count. And SBI Holdings is already first in line. SBI filed for a spot Bitcoin and XRP ETF back in August 2025, and it's targeting 5 trillion yen, roughly $32 billion in assets under management within 3 years of launch. This is the same SBI that is Ripple's largest external shareholder and that has already pushed over $15 billion in cross-border transfers through XRP. As one analyst put it, a Japanese pension fund will soon be able to buy the SBI XRP ETF the same way it buys Toyota stock. Now look, I have to be straight with you here because this is where the headlines get ahead of the facts. Cabinet approval is not the same as law. The bill still needs to clear Japan's diet. The reforms aren't expected to take effect until fiscal 2027, and individual traders won't feel that flat tax until January 2028 at the earliest. So in other words, this transition will take years to fully materialize, but the direction is unmistakable. Japan is rebuilding crypto as regulated institutional plumbing. Now, you might assume Hong Kong is doing the exact same thing, just flinging its doors wide open to anyone with a stablecoin idea. Well, not really. That assumption falls apart the moment we take a closer look at the actual approval numbers. When the city's stablecoins ordinance took full effect in August 2025, 36 companies lined up to apply for an issuer license. On that very same April 10th, the HKMA granted exactly 2. That's a 5.6% approval rate. And of course, when the regulator picked its winners, it just so happened to pick the 2 most established names imaginable, right? License number 1 went to Anchor Point, a joint venture led by Standard Chartered alongside Hong Kong's dominant telecom HKT and Animoca brands. License number 2 went to HSBC. Hong Kong has set up a velvet rope, and the only people getting past it are the incumbents who already run the financial system. The HKMA isn't even pretending otherwise. Its officials have stated that additional licenses will be very limited, explicitly preferring a test-first, expand-later approach. So in other words, let's watch how the banks perform and then maybe we'll let a few more in later. But here's what gets genuinely revealing. Bernstein estimates Hong Kong could capture between 65 and 75% of Chinese crypto demand by 2027. Think about what that actually means. The mainland ban on crypto stays firmly in place, while Hong Kong becomes Beijing's deniable, fully controlled on-ramp for all that pent-up Chinese capital. And we know it's controlled because of what got rejected. JD.com and Ant Group both lobby to issue yuan-backed stablecoins. In October 2025, following directives from Beijing, both companies suspended those plans entirely. The HKMA even issued its first enforcement warning under the new rules against a firm marketing an offshore yuan stablecoin without a license. So Hong Kong will gladly license a Hong Kong dollar stablecoin run by HSBC. But a yuan stablecoin that might threaten the digital yuan project? Absolutely not. Beijing is holding the keys to this state-managed gate, which brings us to the clearest signal yet of who these floodgates are really for. Korea. Because in Korea, the banks are buying the rails outright. In late May 2026, 3 Samsung affiliates moved to take a combined 4% stake in Dunamu, the operator of Upbit, Korea's dominant exchange, for around 612.8 billion won, roughly $408 million. And Hana Bank went even bigger, taking a 6.55% slice for close to 1 trillion won, or about $670 million. That makes one of Korea's largest lenders the 5th biggest shareholder in the country's biggest exchange. And they're not alone. Hanwha, Mirai Asset, Korea Investment, they're all buying into exchanges too, with deal terms implying Dunamu is now worth somewhere north of $10 billion. So institutions are simply bypassing the customer role to buy the underlying infrastructure. And here's the contrarian gut punch, all of this is happening as Korean retail walks straight out of the door. Let me give you one number that captures the whole shift. In December 2024, Korean crypto trading volume hit 323% of the entire Kospi stock market's turnover. So crypto was trading at more than triple the volume of the whole national stock exchange. By 2026, that figure had collapsed to roughly 8%. And it shows up everywhere in the data. Total crypto held by Korean investors got cut nearly in half, falling from 121.8 trillion won at the start of 2025 to 60.6 trillion won by February 2026. So where did all of that money go? It rotated into AI and semiconductors. The Kospi is up almost 27% in a single month, and Samsung Electronics alone is up over 50%, recently touching $1 trillion market cap. Retail investors simply rotated their capital into chip stocks. So now picture the full scene. The banks are buying the casino at the exact moment the gamblers are cashing out and walking across the street. The floodgates open as the crowd leaves. Now, before we go deeper, if you want to keep ahead of these shifts as they unfold, our crypto newsletter breaks down exactly these kinds of moves before they hit mainstream headlines. It's completely free and the sign-up link is down in the description. Okay, back to it, because the deepest layer of this entire story is the one nobody's actually talking about. The real story here is a quiet settlement war. So if we zoom out, the true game suddenly appears. These nations are racing to control how money actually moves across Asia and to escape the dollar while they do it. Let's return to Japan once again. On June 1st, 2026, the LDP's blockchain panel formally urged the government to promote yen stablecoins for settlement across Asia. The lawmaker behind it, Junichi Kanada, said it plainly that they urged the government to take steps to promote yen stablecoins for settlement in Asia in the future. And this isn't abstract. Japan's 3 megabanks, MUFG, SMBC, and Mizuho, are studying a joint stablecoin issuance, and roughly 40 to 50% of Japan's trade with Asia is already settled in yen. Korea is simply running the same playbook. 8 Korean banks, including KB Kookmin, Shinhan, and Woori, are building a shared one-pegged stablecoin, although the Bank of Korea has created a deadlock by insisting only bank majority consortiums can issue it, which tells you exactly who is meant to own these rails. And remember, Hong Kong rejected those yuan stablecoins? Same war, just fought at a different front. Every one of these moves is a nation trying to plant its own flag in the settlement layer. But here's the catch that punctures this whole narrative. Non-USD stablecoins are still under 0.5% of the entire market. The dollar accounts for roughly 93% of all stablecoin supply, and by some measures, over 99%. So the floodgates are really nations racing to de-dollarize their payment system, and so far, frankly, mostly failing. So why fight a war they're losing so badly to begin with? Well, because the prize underneath it is enormous. The real battlefield is B2B payment rails, the unglamorous plumbing that moves money between businesses. And Asia already handles around 60% of global stablecoin payment volume on an order of $245 billion a year in real economy settlement. And that is exactly why Kraken just agreed to put up to $600 million into acquiring Reap, a Hong Kong firm built specifically for stablecoin payments and cross-border settlement across the Asia-Pacific region. Smart money is quietly buying up the settlement infrastructure where the real value lives. Now, let me give you the honest counterweight, because these floodgates are opening into a cooling market, not a roaring one. I already mentioned crypto VC funding declining sharply as AI absorbs the vast majority of global venture capital. But Korea makes the contradiction even sharper. A 22% crypto tax lands in January 2027, and the finance ministry has confirmed it's proceeding despite a repeal petition that hit 50,000 signatures in 8 days. And on top of that sits a proposed rule that the industry body DAXA warns would push exchange compliance reports from about 63,000 a year to over 5.4 million. That's an 85-fold increase, which the industry has flatly called unworkable. Floodgates in, turnstiles out. We are watching institutional plumbing being laid during a market downturn. So here's what almost every breathless headline is missing. The establishment is absorbing crypto on its own terms, at its own pace, at the bottom of the market. Japan is rebuilding the asset class as regulated infrastructure so that pension funds and insurers can own it through the same channels they already trust. Hong Kong is letting in only the banks, acting as Beijing's managed gateway while the mainland ban never moves. Korea's lenders are buying the exchanges as the public rotates into chip stocks, and beneath all of it, nations are fighting a settlement war to own the rails that money flows through. Look, the honest read is this. The banks watched an entire generation build crypto in the open, and now, during the quiet part of this cycle, they are buying the finished plumbing at a discount. They are positioning to own the toll booths before the next wave of retail money arrives. So for you, the practical implications are specific. First, watch the Japanese diet. The FEIA framework, the tax cut, and any spot ETF approval all hinge on that bill passing, with fiscal 2027 and 2028 as the dates that really matter. Second, watch SBI. If a spot XRP ETF actually clears in Japan, it becomes the template every other Asian regulator measures itself against. Third, watch Hong Kong's license count. If the HKMA stays at 2 and only adds banks, the velvet rope thesis holds. If it suddenly opens to crypto-native issuers, the game has changed. Fourth, watch whether any non-USD stablecoins breaks meaningfully above that 0.5% ceiling, because that is the real scoreboard for the de-dollarization war. And fifth, if you hold crypto through any exchange or wrapper exposed to these markets, understand that bank ownership of the rails is now part of your counterparty risk, whether you choose it or not. So here's the question I want to leave you with. Is Asia opening the floodgates a structurally bullish signal the moment the deepest institutional capital on earth finally commits and builds the rails for the next decade of growth? Or is it the establishment capturing crypto entirely, absorbing the infrastructure during the downturn so that when the money finally pours in, the little guy is standing on the wrong side of the gate? Please get highly opinionated in the comments, because this is the binary that defines who actually owns crypto in Asia for the next decade. And if you want to understand exactly how stablecoins are becoming the battleground for global settlement and which currencies stand a real chance against the dollar, then check out our deep dive right over here. Thank you all so much for watching, and I'll see you again very soon. This is DC signing